Good afternoon. It's great to be with you and looking forward to another day of the Simple Plan Live. I'm Brad Macbeth, your host, and looking forward to sharing with you some pretty interesting information today about how to build or what it looks like to build a financial plan. And it is an interesting business, to say the least. And it's as much art as it is science. And so there are principles involved, there are calculations, and of course there's really also, most importantly, what clients, what you, whose plan it is, want out of life. So let's get to it. As always, of course, you can find us on Facebook, and also you can find me on Facebook at Macbeth Group. Also find us on Instagram and Twitter. Instagram, we're at Macbeth Group as well. And on Twitter, we're at Cash Coach Canada. I want to thank our sponsor today, the Simple Plan Life Insurance. Get your free quotes, no obligation, at getthesimpleplan.com/quotes. That's quotes from all major Canadian insurers. You can compare pricing there. And if you're not sure how much life insurance you should be carrying, go to getthesimpleplan.com/how much. You can very quickly see if you might be saving some money, or you might need more coverage, or maybe you've got too much coverage for the situation you're in. Also, just as we heard on an episode a little while back, a couple of things are going on. One that's good news, the little bit of good news that comes out of the pandemic, and that is it's easier than ever to get life insurance. You can get up to $2 million of life insurance coverage now without having to have someone come to your house, or you go to their office, or having to do those nasty blood tests and give urine samples. Also, it looks like insurance rates are likely going to start rising. It's already started, and it usually takes insurers a while to do this, but because interest rates are so low, insurance companies rely on the returns they get on the premiums they gather, and then they invest. And so insurance rates are low. They tend to have to raise rates, and when interest rates are low. And so interest rates are lower than they've ever been, and they're looking like they're going to stay that way for a fair while. So you might want to take a look at that. You're probably going to start seeing in the next few months, toward the end of this year, early next year at least, you're going to start seeing, A, we're going back to all those tests, and B, that prices are going to start to move up. We have a helpful tool for you today. If you haven't used it before, the Simple Plan Retirement Calculator. You can get it at bit.ly/SPRetireCalc. That's bit.ly/SPRetireCalc. That's all lowercase. And that calculator will help you to figure out how much money you should be saving, and both how much you're going to need to accumulate in your nest egg to hit your target for your retirement, and also how much money you should be saving every month to hit that target. So take a look at that. I think you'll find it very helpful, and it certainly ties in with today's topic. All right, we're going to get right to it. Today, we're going to look at the nuts and bolts right inside what it takes to build a financial plan. I want to show you how different information, different inputs affect calculations, and which, of course, they're not just calculations, they're how you're going to live in retirement. So last time we looked at what a financial plan actually looks like. We looked at the output and went through what that entails. Now we're kind of working backwards from the end here. The end result is the output plan itself, and now we're going to work backwards to see, well, what's the information that's inside there, so that we can refine things to get to where we want to go, so we have our financial life fine-tuned for you to hit the retirement that you're looking for. And of course, the major factors in retirement planning for what you're going to accomplish are how much you're contributing, how long you've got, which is also driven by when are you planning to retire, and what rate of return are you anticipating. So you can see we have this tool. Of course, different people use different tools, but I have this tool up there right now called Snap Projections. I like it because it thinks the way we think. There's lots of other tools out there. This tool also produces a report that's digestible. A lot of them will produce like 100-page report, which, if you're the complete financial nerd, if you really like spreadsheets and tables and details, that's great. But for most people, it's like, listen, just give me the basics that I need to understand. So we've got this person here, this fictional person named Jen Snapper, and I've already input some of her information. You can see here she has taxable annual income from her job of $65,000. That's employment income. She's, of course, making her contributions to CPP and EI as she needs to. She's got a bank RSP right now of $39,609 that she's contributing $2,400 a year to. And she's getting about a 5.6% rate of return on that right now. So, fair to middling rate of return. She's got debt. She's got a line of credit at $20,000. She's paying that off at about $6,000 a year. And she's got a mortgage on a home. And her home here is the real asset that's worth $468,000. It also calculates her marginal and effective tax rates. Her marginal tax rate is the amount that she would pay on the next dollar she earns, so every dollar over the $65,000 she's already making. Her effective is what we might think of as her average tax rate. That is, for every dollar she's earning, the average amount of tax she's paying is about 17.6% right now. You know what? You should know this stuff about yourself. And if you don't, by getting a financial plan done, that's how you learn some of these things. This is valuable information for you to have just to know your own financial picture. This calculates her estate. If she were to die today, her estate would be, so this is effectively her net worth, $242,840, and she would pay $13,000 and some in tax on that. Well, why would she pay that? She doesn't pay it on the principal residence because that's her principal residence. It's exempt from tax. But she would pay it on her RSP. So if that were fully deregistered all at once, she would pay about $13,000 in tax there. So that's Jen's picture. It's not a bad picture. We'd like to see her get rid of that debt once and for all. The sooner the better, especially the line of credit debt. But, all in all, not doing too bad. And so what we want to look at is, what is it going to take her? Or the first thing we look at is, what is the trajectory she's on now? Where's that taking her? Where is she going to end up? And so, right now she's planning on making contributions to her bank RSP. And she's also at some point in the future going to collect CPP and OAS. So we're going to go add that in. We'll just add her government benefits in because, when you get there, you are going to get your CPP and you're going to get your OAS. It's extremely unlikely that those would disappear. CPP is fully funded out of premiums now. That's why premiums have gone up so much in the last 20 years. And that's great. It's painful, but it's great. And then OAS is an entitlement that it would be political suicide for any government really to touch either of those. And so they're very unlikely to do that, except under the most extreme circumstances. All right, so we come into our government benefits screen here, and we're just going to enter what percentage of CPP is she going to collect? Well, listen, you can find that out. You go to Service Canada on the Canadian government website. You can actually, you'll have to jump through some hoops if you don't have your ID already, but you can actually go there and find out what you can expect to collect in CPP based on your current level of contribution and what age you would collect. Obviously, that's less certain the younger you are, because if you're not maxing out your CPP based on your income, then it's hard to project exactly how much more you're going to make over the next, if you're 35, you might have another 30 to 35 working years. Okay, so we'll just say that her percent of CPP is going to end up, I'm going to say for her around 80%. Might be a little less than that, might be a little more, but that's a safe one. Now, what I want to do, and then this inflation rate for CPP, this is based on the amount that CPP has been increased over the last 2 decades annually. So that's why I use that number. And then OAS, old age security. If you've been in Canada working for your entire working life, you are going to collect 100% of OAS when you reach age 65. So we're going to put that at 100%. So we'll save that. Come along. There we go. Okay. So right now, so what we want to do is 2 things. We want to manage our after-tax spending, because really that's the 2 important numbers to people are how much am I going to have to live on in retirement, which tells us if we're going to run out of money or not. And the other is how much am I going to leave behind as legacy when the time comes for me to shuffle off this mortal coil. And so we'll get that calculation here. So what I want to do is 2 things. I want to set an age at which the program is going to automatically manage her cash flow to a specific level. So we're going to say age 65. So let's imagine she's going to retire at age 65. We say, all right, let's do that. And then we ask it to come on. There we go. Run the sustainable scenario from age 65. So now it's going to tell us, this is giving us the outcome of with what Jen is saving, accumulating right now, contributing to her RRSP, contributing to CPP and OAS, what she can live on. Also, you'll notice right now, it's telling us how much she's making or how much she has to spend after taxes in real dollars. This is after she's paid her mortgage and made her investment and such contributions. So today, she's living on $31,506, assuming she's not accumulating more than what she says she's saving in her retirement plans. All right, so here's our number. We can see it running down here. She's only on track to be able to live on $22,613. Well, that's not great. Her house would be paid off, and so that's good news. In fact, we can go over here and look at that, because that, of course, is a critical question. When is your mortgage going to be paid off? Well, her mortgage is paid off here on this line. Which is, it's just being paid off at her age 64, so it's on the slow train. So that might be something we want to look at picking up the pace on. Anyway, so this is what's happening. She's going to have $22,613. Now, I want to point out that this is in what we call real dollars. That means it's adjusted to today's numbers. That's in 2020 dollars. She will actually have $47,433 that she will get at that time. But the buying power based on our inflation calculation is only going to be the equivalent of $22,613 today. The program is calculating all that for us. All right, so when we look at this, we go, okay, well, that's not what she wants. She's currently living on well over that and probably going to earn more in the future. So we'd like to see her do some more there. So there's a whole bunch of different things we can do, but let's just do 2 basic calculations. And again, I just want to clarify that the nominal dollars there is the future dollars in the future years, how much it would actually be, but the real dollars is expressed in today's money. Okay, so let's, one thing that we haven't done is we haven't given her any raise here. So she's got her $65,000 income. But it's, in fact, it's going down a little. I don't remember why it went down a little. Oh, no, sorry. That's the taxable income. So her employment income is here. We haven't increased it at all. It's staying at $65,000. So let's at least give her, which means, of course, she's losing money. Her buying power is eroding. So let's index it at 2.5%, assume she's going to get some raises that go beyond the rate of inflation, and we're going to make that happen all the way through to her retirement. So we've entered that, so you can see now her employment income is increasing, and we'll just rerun the scenario. And so when we get there, we find, oh, we have to redo our, come on. We have to redo our run sustainable scenario. So we rerun that. Speaking of Jeopardy, if you watch it, and I do sometimes, they were showing reruns this week from the first years it went into syndication, which it's a bit of a hoot to watch. It's pretty crazy. Okay, so still 22,613. Well, why is that? Well, it's because she hasn't saved any more money, right? So we made her earn more money, but all that meant was she went out and spent more money, in theory. So now we'll say, well, okay, this is good. This is the right base scenario. And if we go right to the bottom, which is the end of her life, we'll see where she's going to end up. Because this is what we're really planning about. And so she's going to end up with capital assets of 0. What that means is she'll have run her RSPs and all of that down to nothing. It's calculated out to age 100 in this case. I think that's where we're at. Yes, age 100. And she'll have real assets worth close to $6 million, which sounds spectacular, but that's just the value of her house. It's gone up. It's gone up in value, and it's gone up in value at a rate faster than the rate of inflation, because you can see that's the future dollars. It's worth $6 million. That's worth the equivalent of $1.2 million today. Now, that's based on the notion that her real estate is increasing. I think I entered 4%, because that's about the average that real estate tends to increase at. It depends where you are, of course. When people talk about the Canadian real estate market, there is not just a single real estate market. There are many, many real estate markets within Canada. Some markets, you won't find those numbers budge at all. It just won't go up much at all. Others, it's going up much faster than that. So, but overall, average, you're looking at about 4% increase over the long period for real estate in Canada. So what that means is when Jen passes away, there won't be any cash left for investments or anything to distribute to people, but there will be a house that remains to be sold that would leave her estate at $1.2 million in today's dollars. Now, of course, if she needed more money than that, she could always have sold her home along the way and put that money to use. So then we would just start to look at, this is our base scenario, and it's from here that we start to examine, okay, well, what are we going to do instead? What are we going to do to make things work out better? Because Jen doesn't want to live on just $22,613. And so I will make just the one slight adjustment here, and we're going to, let's see, she's setting aside $2,400. Well, we like to say that you should be, rule of thumb, saving 15%. What I would really do is go and do, we want to figure out what does she need to save to hit her objective. But let's say she was going to save 10% of her income, which would be $6,500. And so we'll set it to $6,500 till she's age 64. And you know what? Because we indexed her income, will index her contributions as well. And so there we go. That's going to have a number of effects. We'll run the sustainable scenario again. And there we go. Let's scroll down and see what the prize is for Jen having been much more diligent about saving money. And the prize is now she's up to $30,078. She has increased her income, her future income, the amount she's going to be able to live on, by about 35% there. So it's a start. Probably not, still not exactly where she wants to end up. And we haven't looked at as if that's the right choice or what have you, putting it in an RSP. Now, one of the things that we could do is also look at, well, what about this rate of return here? That kind of 5.6, do you like that? Well, that's a pretty conservative, in my opinion, rate of return for someone who's 35. If you like following the more aggressive practices of some of those well-known financial gurus out there who advocate 100% equities, and if you've got long periods of time, and particularly if you go with an index, with index funds in equities, that's a pretty reliable way to go. There will be lots of up and downs, and you're going to, that's called volatility. Sometimes it's measured as risk, but it's volatility, and you are going to have to be able to ride it out. So, for example, earlier this year, when things dumped for about, really badly, for about 2 months, and we went on a 30% drop in really 8 or so weeks, you have to be comfortable and confident about that. Now, it has come back most of the way from that drop, not all the way yet. It's down about 5% from the peak, but still, you got to be able to stomach that. So let's imagine, let's go in and look at, we'll just make this one change to just show you what an impact that can have. So we're at 5.6%. So with her bank RSP, we're showing the rate of return on cash at 1.25. You'd be doing well to get that right now. She's in 50% fixed income at 2.75%, so that's bonds and such. And she's at 50% equities at 8.5%. So let's say that we go to 20%. Well, you know what? Let's go all the way. Let's just go 100%. We'll go 100% equities at 8.5%. All right, now we've made that change. And we'll rerun our sustainable scenario. Things are really churning away today. All right. Da-da-da-da-da. Here it comes. All right, now. So let's bear in mind, what have we done? We've made 2 changes to Jen's scenario. We made the change to increase her contributions so that she's putting away 10% of her income, which got us to $30,000. So, you know, that's a significant sacrifice. She went from putting $2,400 in to putting over $6,000 in. So she, you know, 2.5 times, setting aside 2.5 times as much money. That's a big ask for people. But then we went from just over 5% to 8.5% as a projected rate of return. And that's getting us more where we want to go. $48,000 in after-tax spending in real dollars. She'd actually start out at about $102,000 at that stage of her life. So this is what we do when we go through these financial plans. We're going to drill down a bit more next time into some of the subtleties and some of the choices we make to really fine-tune some of this stuff. So I hope you're getting a sense of both how critical it is to have a financial plan and then to act on that plan and review it every year. So just as an example there, we decided, well, we better set some more money aside. We also decided we probably want to try and get a better rate of return than what we were getting. Now, there's risk with that, but this is why we review every year as well. So I hope that that's helped you today to understand part of what goes into a financial plan, why it's so important to have a financial plan. Really appreciate you spending the time with us today. We'll be back again on Friday and drill down into this a bit more to give you an even deeper understanding of what you should be looking for in a financial plan. I'm Brad Macbeth. You can find me on Facebook. You can find at Macbeth Group. You can also find me on Twitter at Cash Coach Canada and on Instagram also at Macbeth Group. Want to thank our sponsors today, the Simple Plan Life Insurance Plan. You can get quotes at getthesimpleplan.com/quotes to just check out how much you might pay for coverage or whether you're even paying too much for coverage right now. Also, getthesimpleplan.com/how much to find out how much insurance coverage you should be carrying. Just to remind you, you can get your own start on your retirement thinking with the Simple Plan Retirement Calculator. That's at bit.ly/SP Retire Calc. Thanks very much. I'm Brad Macbeth. We will see you again later in the week.